Today's cardinal lesson, we're talking about inherited IRAs. And so why are inherited IRAs important? Well, first of all, for you folks watching, many of you have already inherited an IRA, and possibly you're stretching out the distributions over the rest of your lifetime and have been doing that for a while. Second of all, many of you are due to inherit an IRA, possibly from your parents or a brother or sister, and they're just important. And then many of you have IRAs yourself, and you have beneficiaries, and in your planning, at least if you come to me, we're going to be talking about how do you want to leave this? Who do you want to leave it to? And then how do you want to leave it to them? And how do you want them to pay taxes on it after they receive it? Okay, and those are all things that can be planned out. So what we've got going on here is the Secure Act, which is a little bit of old news by now. It was passed in 2019. And the effect that it had on inherited IRAs started with deaths after January 1st, 2020. So we've been living under this for a little over 2 years with anybody where they've inherited an IRA and it's been 2 years or less, they're following under the new rules of the Secure Act. And so why are we talking about this now? Well, the IRS had not issued regulations putting into practice the changes that were made in the Secure Act. So for a couple of years, we were just reading the law literally and interpreting it and giving people advice. And then now the new IRS Secure Act regulations have hit the street, and there's some kind of different stuff in there, and it's still a little bit of uncertainty, but at the very least, it's confusing. And then they put them out for like 90 days for people to comment or whatever, but they're pretty much in. And so the Secure Act changed things for beneficiaries on inherited IRAs. And I'm going to talk about that. And then they created a new class of beneficiary. And then the new IRS regulations that just came out in February of 2022 changed it again. Okay? So let's talk about the Secure Act. And the Secure Act did a whole lot to retirement plans and the retirement space. Changed a lot, more than just this. But all we're talking about today is beneficiaries and inherited IRAs. And what they changed is before 2020, so if you inherited an IRA with a death 2019 and before, you were able to stretch the distributions over your lifetime. And the reality is most folks don't stretch it. Most folks, because this is the first money, the IRA money, that shows up when an estate is settled. Because it doesn't go through the estate, it doesn't go through probate. IRAs have a named beneficiary, and so most people name their kids or their spouse, and when it's a case of the second death and you're naming the kids, this is the first money that the kids receive. And if it's traditional IRA money, which most of it is, it's taxable. So if they draw $1 out of there, which they have to start taking some money, that's what this law is all about. But to get any of the money, they've got to pay taxes on it. And for a lot of people that are beneficiaries, this is the first money that they can get their hands on. A lot of beneficiaries just clean the account out, just take it, even though 40% of it goes to taxes. They want the other 60% so they can get their hands on it. That's what we want to try to avoid when it comes to your planning for your estate, so your kids are a little better, or adult kids are a little better educated, and we have a little better understanding of their situation so they don't do that, so that they're going to at least possibly spread this out over several years to minimize the tax bill. A whole lifetime of work and earnings in an IRA can be wiped out with just a quick transaction by an adult child that's a beneficiary. So what the Secure Act did is it said, okay, we're not going to allow these lifetime beneficiaries anymore. So, or lifetime distributions where you're stretching the tax out. You know, a 60-year-old person inherits an IRA and they can stretch those distributions from 60 till they ultimately die at 95. I mean, that's a long time. And they say we're going to take it from lifetime to 10 years. And so the 10-year rule came in effect for deaths 2020 and after. And so we still had a limited understanding of how the 10-year rule works, because it isn't like you had to take a certain amount every year for 10 years. The way it really worked, and for some people this was actually better, is you could take nothing for the first 9 years, and then in the 10th year, take it all out. The only rule in the 10-year rule is that it has to be empty by the end of the 10th year after the person passes away. So, but that's not really smart planning either, because, you know, if you had a $300,000 IRA and to take it all in the first year right after somebody dies, you know, if 40% of it's gone to taxes, that leaves the beneficiary 180 grand. If you leave the whole 300 in there for 10 years and it grows to 500, and then you take the whole 500 out in the 10th year, that's even more taxes. It's, you know, it's 200,000 of taxes if you use the 40%. It might even be more than that, because the person's tax bracket, the beneficiaries would just be blown out of proportion. So the real thing that you want beneficiaries to do when there's a tax liability is at the very least spread this over a number of years so that it doesn't make their income have a huge spike and they get into a high tax bracket. And that's what we do in our planning for people like for your IRA. I mean, that may not be the top of your list. The top of your list may be your own planning and your own distributions out of this thing. And you're kind of saying whatever's left the kids can have. That's what people say to me. But when I watch them, and I watch them just squirrel money in their IRA and just take out the minimum, they actually, it plays out that they're saying that this IRA money is for me, but then they're reluctant to actually do that. So it leaves a bunch of pre-tax money going to their beneficiaries at their death. I mean, that's just what I've witnessed throughout my practice. And so I try to help people put together a plan where they're not going to put anybody, including themselves, in a high tax situation. So the Secure Act changed it from lifetime to 10 years. And then it also created a new class of beneficiaries. We didn't have this before. And they're called the eligible designated beneficiaries. How's that for a mouthful? I mean, I just love these acronyms that are created effectively. I guess this one was done by Congress or the writers of the bill, because this is actually in the Secure Act. Eligible designated beneficiaries, and we're going to call them an EDB in that fund. So, you know, you got another acronym that you don't know what it means, but I'm going to tell you what it means. An eligible designated beneficiary is either a spouse, so your spouse can be an eligible designated, children under the age of 21, but you know, if you're 60 now and you're doing the planning and you say, oh, I'm going to name my kid because he's just 14, but by the time you die, he might be 34 or 44, this isn't going to work. But if a person dies, well, they have children under 21, and then one of those children, or several of them under 21, are actually the beneficiaries, they're an eligible designated beneficiary. I'll tell you what that gets them in a sec. A beneficiary that's disabled is one of these, and anyone less than 10 years younger. Isn't that, this is right in the law. I mean, anyone less than 10 years younger. So that means somebody about your same age, a little younger, or older, like your brother or sister, or your best friend, or your boyfriend or girlfriend, or just whatever they are, if they're around your age, let's put it that way, they can be an EDB. Okay, and so what does an EDB get? An EDB, an eligible designated beneficiary, can still do the lifetime deal. Okay, they don't have to go on the 10-year deal. That's it. Okay, so we've worked with that. Doesn't sound like a big deal, but believe me, it is, and it's left a lot of beneficiaries really in the dark because this stuff is pretty confusing. A lot of financial advisors don't really study this stuff. I'm holding Ed Slott's book. Ed Slott I'm one of his groupies. I mean, or his master elite advisors. And, I go to him. He's America's IRA expert. He's a CPA out of New York, and he's made a business, written a lot of books, and he just has a whole team of people that all they do is study IRAs and pension plans and try to advise and teach lawyers and financial planners like me. And then we sign up and be part of his group so that he does a lot of the research for us. And then we go to meetings with him and we learn all this kind of stuff. And the real reason for learning it, you don't have to get the detail that I'm giving you here. I just want you to understand that there's ways to plan your retirement and then plan your estate so that you pay less taxes than you otherwise would pay, and that the money goes swiftly to who you want it to go to. So that's what I do for a living. He's my source when it comes to IRA money. Now, the IRS, they come out with this regulation. They've been preparing it for a couple of years, and they added something. So they said now, if the deceased already started RMDs, required minimum distributions, so it pretty much means if the person who died is over 72, and they've already started distributing to themselves over their lifetime, and they died 2020 or after, that's going to be the case if what we're talking about now for the future, and they already started RMDs, so if they're not an eligible designated beneficiary, what they need to do is what you're going to need to do if you're the beneficiary is you're going to need to take RMDs, or required minimum distributions, years 1 through 9. And then in the 10th year, you're going to need to empty the thing. So they've added something. So if you inherit this money from like your parents, one of your parents, and your parent was 85 and they've been collecting, or they've been distributing to themselves, they're already in RMDs, and you inherit, let's say, $400,000. Before we read this rule in February, we thought you could just take that $400,000 and just take it out in any way you want to do it. It just needed to be emptied after 10 years. Now, what we've got to do is we got to take RMDs starting this year, or with the year they die, and then every year we can take more, but we can't take less than the RMD 1, 2, 3, 4, 5, 6, 7, 8, 9. And then whatever's left by the end of the 10th year, then we have to draw it all out. We can take more, we just can't take less. So I'm sure some of you are going, wow, I'm just going to call you when I inherit money, and that's not a bad idea. I wouldn't expect you to memorize this stuff. You could say it's kind of boring, and the reason it's not boring to me is I deal with clients dying every week. I mean, we're dealing with this and helping out the heirs, so it's not boring to me because people come in with what they want to do, and then we tell them what they can do, or if they can do what they want to do, we show them how much taxes they're going to pay and possibly propose a different way. So knowing all this stuff is real interesting to us, and it helps people. Now, so why does it matter? Two things in your planning. Number one is you might inherit an account. You might be due to inherit an account. You're not sitting around waiting for somebody before you to die, but a lot of people, when that's coming, they know that, and it's an IRA, and we can kind of prepare for all of this and just plan out so that it doesn't kill you tax-wise. And then for your own accounts, in your own plan, in your own beneficiaries, if you're leaving it to your children or your spouse first, and then maybe the second one of you, if you're a married couple that passes away, it's going to go to the kids. And then you may have kids that are going to treat this differently. You may have one kid that's just going to clean out his or her third, and the other two kids, you're hoping they're going to stretch it to their best thing, but we can at least get a picture of that, and you can put your wishes down. The other thing that I'd suggest in this planning, and we do a lot of this, is there's a lot of people, let's take this back to your age now. If you're 63 or 4 and you're planning out your retirement, I mean, for some folks, that retirement money or that IRA is for them. I mean, they're saying we got to create an income because they got to live on that to supplement their Social Security check. That's some folks, but there's probably still going to be something left at the end. And especially we don't know when the end is, so we still need to plan it out. But what I was going to mention is we have a lot of folks doing the Roth IRA conversion, and they're starting to do that in their 60s so that they don't face RMDs at 72. And then when they inherit or they pass this money on to their kids, it's going to be tax-free to the kids. I mean, the Roth conversion is one way to do that. Another way to do it is with RMDs, just take the RMD every year, pay the taxes, and use the difference to purchase life insurance. And then life insurance will come to their kids tax-free. You just name beneficiaries the same way as this, and they don't have all these rules to follow. Another way to do it is just to pull it out, pay the taxes, put the money in an after-tax account, and just live off that, use it, just have it, and then leave that to them, and at least they don't have a bunch of rules in how they inherit it. So there's a lot of planning we can do around this IRA, and I'm finding that people have a thirst for this, and they kind of know about this stuff, and they really, this is what we do day in and day out, is we help people plan out their whole retirement, and then we do estate planning to make sure that things are left to their family to their liking. So I'm Hans Scheil, and I thank you for listening.